All right, here we go again. The market's at an incredibly important price level right now that if we see that level successfully defended, we'll probably end up with a pretty decent rally into the second quarter of this year. Otherwise, if we see the price surrender and close below here today, we're more than likely heading for a true bear market. Welcome to Doc's Market Minute for Monday, the 7th of March. Here's the daily chart of the S&P 500 futures. Let me start off by talking about this important price level, which is S&P 4222. And that's the level on the front month futures contract that we have, not the cash index, SPX, but the futures. And you'll notice that this is the 61.8% retracement that the price has rallied up and come back down to. The 61.8% retracement represents kind of the last line of defense for the bulls, that if the price closes below here, then we're going to, at the very least, fill in the triangle. Now, the only way from the market to rally at that point is if we do have a severe undercut, which is very similar to what happened back here at the end of February. The best case scenario for the bulls is if 4222 is successfully defended today. I don't care if it's undercut, but if it closes well above that level today, we might start to see a very sharp short covering rally back up to the upside. What this would cause is a change in polarity back to the upside. This would take this former downtrend with lower highs and lower lows, all of a sudden changes it to an uptrend and causes massive short covering. So that would cause a change in polarity backed up to an uptrend on the daily chart and may kick off a strong reversal process. And that all depends on 4222 being successfully defended. So I'll call that scenario number one. Scenario number two is if the price does close below 4222 today, and then implies that we're going to see at the very least a retest of the bottom here at about 4100, which matches out to about a 14.7% haircut off of the highs. Now notice what happened here at the end of January and the end of February. We did have a double bottom undercut, which can create massive short covering moves. However, it did not at this time. We got too much uncertainty coming into the market for the market to handle. And when there's uncertainty, when in doubt, palms out. That is the old floor trader way of saying sell everything you got. And so far, that's what we've seen over the last couple of days. So there is a scenario number two where we get a retest or maybe even a slight undercut of the February lows at this point on the 24th. And then this also can cause a short covering rally if certainty comes back to the market. So that's scenario number two. Scenario number three is if we do get the close below that 4222 level today, and we close below the lows in February. I believe that's the 24th. If it closes below the lows in February and undercuts a new low for the correction, then I think it's highly likely that we end up dropping to at least a full 20%. Now, if we do fall into scenario number three and we move into a full bear, let me walk you through a couple of past bears where we did hit that numerical 20%. Now, one of these is just a deep correction. The other one is actually the true entry to a bear market. So I'll delineate the two between. The first example here comes in 2018. At the end of 2018, we had a big disconnect between the Fed, who wanted to raise rates, and the economy, which was starting to slow down. And so that disconnect did cause, at first, a full correction of 11.4%. But then when it became obvious that Jerome Powell was going to act unilaterally and raise rates regardless, the market sold off really hard. And so you'll notice that the worst selling always occurs at the very end of a corrective move like this. And into the end of 2018, we had a full numerical bear. And I call that a numerical bear because it did hit the definition of a bear market, which is 20%, but it doesn't have the same structure as a true bear market, which typically lasts for 18 months or maybe even longer. Notice that after certainty came back to the market, which was in the form of Jerome Powell saying, oh, look, I was just kidding about the rate hikes and we're going to undo that and we're going to get in step with the market and everything's good again. Then we saw new highs in the market before the first, pullback from there. So when certainty comes back into a market, the relief rally can be stunning from these. So make sure that you're prepared for this and are not completely fully leaning long at the very bottom, which is where most retail traders are. Our next example comes at the absolute market high at the time, which was in October 2007. And from the top came into a corrective move. So this is a weekly lower high setting up here and a lower low. And the worst selling happened into Martin Luther King Day or thereabouts in January of 2008. Now, notice what happened from here. We did get a small relief rally that came back up again, but once again, here comes Bear Stearns, and now we drop to a full 20.2% with an undercut double bottom. I love these undercuts because they can get a lot of short squeeze going, and we actually did get a fair relief rally, but this is the biggest difference. This is the difference between a correction, which is what we've seen lately, and a full bear market, which we have not seen since the 2007 to 2009 period. Here's the difference. This is what happened here, is that we had a small relief rally for a couple of months, and this creates a monthly lower high, rolls over, and we were toast. The market was done for the rest of the year as the selling got stronger and stronger, and more uncertainty came in, and we really just completely dropped into the very bottom in March of 2009. So enough for the history lessons. You can see that this level is extremely important. If we do lose this level today, 42.22, then the odds are highly favorable that we end up at least retesting the lows from here, in which case we can either get a short covering rally coming from that level and limit the damage to about 15%, or if we close below that level, that opens the door to a full 20% bear at least. The stakes could not be higher right now, all based on that one price level. The market craves certainty. Will it get it in the next day or so, or will the uncertainty continue? Thanks for listening. We'll see you in the next Market Minute.